Hey, welcome back. My name is Brian Winter. I'm a tax attorney and accounting professor, and you are watching part of my accounting series for Intro to Financial Accounting. So if you're in your first accounting class, this is a right place for you to be because we go ahead and we break this down a little bit to make it a little easier to understand so you can continue to advance through your other courses, whether you're going to be an accounting major or whether you're in a marketing or business or management or other business type of major. All right, so what are we doing in this particular video? Well, we're now focused on the accounting cycle, the end of the period. So we've already dealt with the intro to the framework, right? And then what we did is we dealt with the accounting period where we went through the process during the period. Now, that was our last video. And this is where things really start getting a little bit confusing for students. And sometimes they start to panic right here between the second and the third video that things are going to get so complicated because you're bombarded with new information and we don't want to panic here. Okay, so this is one of those points where you need to understand these last two videos pretty well in order to continue through. It gets, in my opinion, a little easier after this because we can become more familiar with the terminology. But in the last video, what we need to know before we really get through this video is how do we generally record a transaction? Remember, so we're going to have at least two accounts that are going to be impacted on every transaction. So how do we record a transaction? And then the other huge thing that you needed to know from the last video was the debits versus credits. And when does a debit increase a value and when does a credit actually increase the value? And if you recall from our acronym, we used dealer, D-E-A-L-O-R, right? Dealer. And if it's DEA, then a debit increased the account. If it's the LOR, your liabilities, owner's equity, or revenue, then the credit went ahead and increased the account. So if you're not comfortable with that terminology yet and you don't have it down pretty strong, go back and watch that video too, so that way you're making sure you understand this terminology. Now, what we're going to do here is we're going to continue to go through the accounting period, and more specifically, what we have to do at the end of an accounting period is we have to make some additional adjustments. So we have to go ahead and record some additional transactions, but these are adjusting entries, and we're going to talk about that here in a second. In addition, what we're going to do is we're going to close out some temporary accounts into what are known as permanent accounts. And then what's going to happen is we need to understand our financial statements. So we're going to put together some financial statements as well. That's the focus of this video. So if that sounds like what you're after, well, this is a proper place for you. So let's go ahead. Let's get started. All right. So as I just mentioned, what we're doing is we're going through that accounting cycle. And from the last video up until this video, what we've done so far is we've learned how to go ahead and record these different transactions. We've done our journal entries. We've done our general ledger, and then we brought it all over to the unadjusted trial of balance. In addition, we even talked about the T accounts before we got to the unadjusted trial of balance. And we learned all kinds of terminology such as debits and credits, important terminologies, right? Okay, now what we're doing is we're dealing with the adjusting entries. That's where we're at right now. But from that point all the way through the remaining closing entries, that is this video. So we're doing the adjusting entries, we're doing the adjusted trial balance, the financial statements, and the closing entries. That's what we have left. And then you're going to be through the accounting cycle and we can move on to other types of topics. So let's go ahead. Let's start with our adjusting entries first. Okay, so I think the first fair question that you need to be wondering is, what the heck is an adjusting entry and why do we even need these adjusting entries, right? Because we need to understand the process or why we need it before we can actually get through and do these things. So what happens is normally we're just chugging along during the accounting period and we're recording transactions, we're selling products, we're paying expenses, we're doing all those general things that a business does. And we have our transactions as we go through each of those things, right? We buy equipment, so we reduce our cash, we increase our machinery or our equipment accounts. So we do those types of things. But you know what? Sometimes things happen that at the end of an accounting period that have not yet been recorded, right? So let's say we're just chugging along and we're dealing with our different transactions. And what we did is on December 27th, we went ahead and we paid salaries expenses for the month of December. So they get paid every couple weeks and we went ahead and we wrote that check. But they're continuing to work throughout the remainder of the year, right? So we're going to continue to do this. So what happens is when we look at our actual transactions, we've gone through and we have journal entries for the last period in which we went ahead and paid our expenses, our salary expenses. But certain things still occurred. We still had employees working through the remainder of the year, and because they were working, there are certain expenses that we incurred. Now, when we're dealing with this cycle, what we're generally trying to do is we're trying to match when the expenses and when the revenue were actually incurred, when we actually created those, right? So we need to go ahead and make an adjusting entry. So if we're trying to measure what our net income is, remember what our revenue minus expenses, right? So if we're trying to figure out our revenue and expenses, and we had people that were working in December, well, our December financial statements and accounting records should show that we had those additional expenses because people worked through the entire year, not just those first few weeks. So we need to go ahead and make an adjusting entry so that way our records actually show how much we had an entire salary expenses for all the year, not for all the month, not just that first 3 weeks or first 27 days or whatever we're dealing with. It's got to be for the entire month. So we do an adjusting entry because we didn't record anything on that yet. All right. So let's look at these different things of the questions that we should be asking. Have we earned any additional revenue? So sometimes we're still working and we're going ahead and we haven't billed people yet, but we know that they're going to be billed. Well, we haven't had a transaction if we haven't billed them yet. So what we need to do is we need to make an adjusting entry at the end of the year so that way it's reflected in our accounts. And we're going to take a look at all this. Another one, have we incurred any additional expenses? That was a salary example that I gave you. The third one, have any assets been used? So have we been using assets during the year? Because what we may be using is things like prepaid rent or something like that. Have any liabilities changed? So is there any difference in our liabilities? And are the accrued balances ready for the financial statements? Those are what we're really focused on here. Now, in order to understand this, so we can start seeing how we do these transactions. And we're going to see a bunch of transactions here in a little bit. But to understand it, what we next have to understand is what is the accounting system that our client is using. So are they using the accrual basis method of accounting, or are they using the cash basis method of accounting? So let's go ahead and let's take a look at the difference between accrual and cash methods of accounting. Okay, so let's now talk about adjusting entries. Make sure that we're comfortable with this. So when we're looking at adjusting entries, what happens is we really have 4 general categories of adjusting entries. And there's going to be a 5th, which is going to be depreciation. And I will show you that separate because it is different because we're using something that's called a Contra account. But let's just focus on the 4 general categories. Okay. So the first type or the first category that we're talking about are prepaid expenses. And hopefully you remember a prepaid expense is when we went ahead and we paid it in advance. So examples that we talked about in previous videos, prepaid rent. So we pay the rent, say a year in advance. Well, you know what? We've already paid our rent for an entire year. So that's an asset because we don't have to pay that rent expense anymore for the entire year. So we record it as an asset. Well, each month we're going to be using part of it, right? Each month. So the month of July, well, guess what? We just use 1 month of that prepaid asset. Now we only really have 11 months left. So prepaid expenses. So it happens you pay it before the expense. We record it as an asset initially. And now what has to happen is we have to go ahead and we have to make the adjustment. The adjustment we do is we're now going to have an expense for that 1 month. So 1/12 of our rent will have been used. So here's common examples: prepaid rent, prepaid insurance, and supplies. Those are your prepaid expenses. So if you see a prepaid rent account or prepaid insurance or supplies, there's likely going to be some type of adjusting entry associated with that. Okay, that's your prepaid expense. But we've got 3 more to deal with here. So let's look at our second one. Second one, unearned revenue. Okay? So what happens with unearned revenue? Well, we haven't earned it yet. So what happens is we receive the cash. So it's not like prepaid expenses where we paid our cash in advance. Here, somebody paid us in advance. Okay? But we haven't done the work. So we have to record it as a liability because we still need to work. We still need to work. Okay? So the revenue is recognized as services are performed. Remember the accrual method. We don't recognize that revenue until we perform our services. So that's why it's a liability. So we need to go ahead and make adjusting entries with that as we continue to earn it. So consulting fees received in advance. Season tickets. So if you're a Vikings fan, Skol, right? If you're a Vikings fan, then guess what? If you have season tickets, the Vikings are going to go ahead and they're recording it as unearned revenue. And it's not going to be, they're going to go ahead and they're going to make adjusting entries as the games are played, as they've earned it. Okay? Gift cards are another thing. So holiday season's coming up and you're going ahead and buying gift cards and all that things. Well, those are unearned revenue. They're liabilities initially for them. Okay? All right. That was our second one. And we're going to work through some examples. You're going to see these different journal entries. We're going to record these transactions for you. Okay. Let's go ahead. Let's look at the third one. Accrued revenue. Okay? Accrued revenue. So we receive the cash after we've already performed our services. So we've performed our services and so far no entry has been made yet. Okay? Well, what happens is once we go ahead and we complete it, we're going to go ahead and we're going to have an asset, right? We're going to have accounts receivable and revenues. We recognize it on our revenues because we have completed it. And if we haven't received the cash, we have accounts receivable because we've completed our work and they haven't paid us yet. All right. So consulting services performed but not yet billed. Interest receivable. So you haven't yet billed them. If you've already billed them, you already have it as accounts receivable. But sometimes you haven't billed them yet. That's where we have this adjusting entry in here as well. And then finally, our accrued expenses, right? Those are going to be where we pay cash after the expense. So we didn't prepay it. We're doing it after it. So right away, no entry yet. But what we have to look at is it's going to impact our expenses and liabilities. So salaries payable, the example I've been giving you, they worked from the 27th till the end of the year. That is accrued expenses. Interest payable, utilities payable. So you have these utilities. Now you've got to go ahead and you got to pay those utilities for that year. We need to make an adjusting entry so we reflect it on our accounting records. All right. Like I said, we're going to work through some of these. We're going to see some transactions and see how we go ahead and make these adjusting entries. Okay, so let's now talk about adjusting entries. Make sure that we're comfortable with this. So when we're looking at adjusting entries, what happens is we really have 4 general categories of adjusting entries. And there's going to be a 5th, which is going to be depreciation. And I will show you that separate because it is different because we're using something that's called a Contra account. But let's just focus on the 4 general categories. Okay? So the first type or the first category that we're talking about are prepaid expenses. And hopefully you remember a prepaid expense is when we went ahead and we paid it in advance. So examples that we talked about in previous videos, prepaid rent. So we pay the rent, say a year in advance. Well, you know what? We've already paid our rent for an entire year. So that's an asset because we don't have to pay that rent expense anymore for the entire year. So we record it as an asset. Well, each month we're going to be using part of it, right? Each month. So the month of July, well, guess what? We just use 1 month of that prepaid asset. Now we only really have 11 months left. So prepaid expenses. So it happens you pay it before the expense. We record it as an asset initially. And now what has to happen is we have to go ahead and we have to make the adjustment. The adjustment we do is we're now going to have an expense for that 1 month. So 1/12 of our rent will have been used. So here's common examples: prepaid rent, prepaid insurance, and supplies. Those are your prepaid expenses. So if you see a prepaid rent account or prepaid insurance or supplies, there's likely going to be some type of adjusting entry associated with that. Okay, that's your prepaid expense. But we've got 3 more to deal with here. So let's look at our second one. Second one, unearned revenue. Okay, so what happens with unearned revenue? Well, we haven't earned it yet. So what happens is we receive the cash. So it's not like prepaid expenses where we paid our cash in advance. Here, somebody paid us in advance, okay? But we haven't done the work. So we have to record it as a liability because we still need to work. We still need to work, okay? So the revenue is recognized as services are performed. Remember the accrual method. We don't recognize that revenue until we perform our services. So that's why it's a liability. So we need to go ahead and make adjusting entries with that as we continue to earn it. So consulting fees received in advance. Season tickets. So if you're a Vikings fan, Skol, right? If you're a Vikings fan, then guess what? If you have season tickets, the Vikings are going to go ahead and they're recording it as unearned revenue. And it's not going to be, they're going to go ahead and they're going to make adjusting entries as the games are played, as they've earned it. Okay. Gift cards are another thing. So holiday season's coming up and you're going ahead and buying gift cards and all that things. Well, those are unearned revenue. They're liabilities initially for them. Okay. All right. That was our second one. And we're going to work through some examples. You're going to see these different journal entries. We're going to record these transactions for you. Okay. Let's go ahead. Let's look at the third one. Accrued revenue. Okay. Accrued revenue. So we receive the cash after we've already performed our services. So we've performed our services and so far no entry has been made yet. Okay. Well, what happens is once we go ahead and we complete it, we're going to go ahead and we're going to have an asset, right? We're going to have accounts receivable and revenues. We recognize it on our revenues because we have completed it. And if we haven't received the cash, we have accounts receivable because we've completed our work and they haven't paid us yet. All right. So consulting services performed but not yet billed. Interest receivable. So you haven't yet billed them. If you've already billed them, you already have it as accounts receivable. But sometimes you haven't billed them yet. That's where we have this adjusting entry in here as well. And then finally, our accrued expenses, right? Those are going to be where we pay cash after the expense. So we didn't prepay it. We're doing it after it. So right away, no entry yet. But what we have to look at is it's going to impact our expenses and liabilities. So salaries payable, the example I've been giving you, they worked from the 27th till the end of the year. That is accrued expenses. Interest payable, utilities payable. So you have these utilities. Now you've got to go ahead and you got to pay those utilities for that year. We need to make an adjusting entry so we reflect it on our accounting records. All right. Like I said, we're going to work through some of these. We're going to see some transactions and see how we go ahead and make these adjusting entries. Okay, so let's break these down now. We've looked at the 4 categories anyway so far, and we'll look at the 5th one here in a little bit. Now what we're starting out with is our prepaid expenses. So that was where we went ahead, we took the money, we paid in advance. Okay, well, we're now using some of that asset throughout the year, right? So we have prepaid rent, prepaid insurance, we have supplies. Those are typical prepaid type of situations. So let's look at our transaction here on the first one. We paid $60,000 on December 30th for 1 year of rent. Okay. Well, the way that we initially recorded this is we went through and we recorded it and we said, well, we're going to go ahead and increase, we debit an asset, right? We're increasing it with a debit because it's an asset with $60,000 for prepaid rent. Then our other transaction was the cash. We had a credit cash by $60,000 because that was lowering our cash. And we balanced after that transaction. Every transaction we should be balancing still, right? All right. So now that we've used 1/12 of that, 1 month of it, well, we need to go ahead and make an adjusting entry. So if we paid $60,000 for 12 months, well, that is $5,000 a month, right? 5 times 12 is 60, right? So 5,000 times 12 is $60,000. So we need to make an adjusting entry of $5,000 for the month of December because we've used it. We need to reduce our prepaid rent down. So what we have to do now is we have to go ahead and we're going to debit our rent expense. Okay, so when we debit the rent expense, guess what? Because we're debiting it, remember, DEA, right? Dividends expenses. So we debited it, we increase our rent expense. So we have rent expense there. And what it does on the credit portion of it is we're going to credit our prepaid rent. So DEA, dividends expenses, assets, right? We increase those with a debit. So how do we decrease them? If it's increased with a debit, is decreased with a credit. So we're lowering our prepaid rent by $5,000 to reflect that we only have 11 months left. Okay, so we reduced it by $5,000. So that's what we'd have done. We'd have debited it by $5,000, credited prepaid rent by $5,000, and we're done for that adjusting entry. Now, there's some others that deal with prepaid expenses. Let's look at a couple more here. Prepaid insurance. We paid $12,000 for 1 year of insurance. Well, hey, if you saw the last one, you should be able to work through this. Okay, so what happens is we go ahead and we debit prepaid insurance. It's an asset. We debit it, which means it increased that asset. And what then happened is we had paid cash because this was prepaid. So we had to reduce an asset. We reduced it with a credit. We reduced cash. So that's how we did our initial transaction. But now we don't have $12,000 of prepaid insurance anymore because that was for 1 year of insurance. Now we only have 11 months left. So if we had $12,000, that means $1,000 a month. So what we're going to go ahead and do is we have an adjusting entry we need to make. So we're going to debit insurance expense because we're matching the expense with the revenue for that month. And then what happens is we credit our prepaid insurance because we are reducing the asset now. We no longer have value of $12,000. It's worth $11,000. So that's what we did. All right. Hopefully this is making sense. I know it's a lot. I know it's not the most exciting information out there, but this is going to help you throughout the process. Now, let's look at our final one. Office supplies. So we went ahead and we bought supplies. I told you my favorite pen, that G207. I absolutely love G207s, right? They flow so well. Okay. Well, when we're dealing with these pens, what happens, or, it could be all kinds of different things. It could be envelopes and all that stuff. But what we have is we purchased $8,000 of supplies. At the year end, it shows we only have $2,500 remaining. So we paid $8,000. So our supplies, $8,000. We increase that. It's an asset because we have things of value. Well, we paid it with cash, so we paid $8,000 in cash. We credit cash. So we debited supplies, we credited cash. That increased the asset of supplies and decreased the asset of cash. Then what we have to do is we have to say, well, we did use $5,500 of it. $8,000 minus $2,500 is $5,500. We used it, so we better go ahead and recognize that. So we had a supplies expense because it was an expense that we use this to help us create revenue. We have our expense of $5,500. We debit our expense and we go ahead and we credit our supplies to reduce the amount we have in supplies. Look at this. If you look at these adjusting entries, notice we're always debiting an expense, rent expense, insurance expense, supplies expense, and then we're crediting the asset because it's being reduced, right? So if you see a prepaid expense and you have these down, it becomes easy to go ahead and say, oh, I know how to do this transaction. Okay, so that's a common theme you're looking for. All right, well, that's prepaid expenses. We've got 3 more categories. Let's look at them. Okay, let's look at the second category now. We've already done our prepaid expenses. Now let's go ahead and look at these unearned revenue. Remember we just talked about unearned revenue not too long ago? That is where we received some money, but we haven't actually done our work yet, right? So people paid us in advance. So we need to make adjusting entries to show that. All right, as we earn the money. So let's look at the first situation. So we have training fees received in advance. So we received $6,000 on December 23rd for future training sessions. By December 31st, 1/3 has been earned. Okay, so what we have now is a situation to where they went ahead, they paid us on December 31st, $6,000, and then we've earned $2,000 of it so far. All right, well, when we first received it, look what happened. We debited cash because cash came in, we got the money, we increased the amount we have in our cash account, and then what happened is we had to go ahead and create a liability. It was a deferred revenue account, right? Because we haven't done it yet. We received the money, but we haven't done the work yet. So a deferred revenue, even though it says revenue, it's a liability. So that kind of tricks you a little bit because it's called deferred revenue, but it's still a liability. So what happened? We debited cash, which increased our asset account, right? A debit increased that. And then we had a liability, DEALOR. Liability, a credit increases it. So when we first had it, we increased cash and we increased the liability. We still balanced. Our accounting equation held. So here's the next portion of it now. We have to make the adjusting entry. So here's our adjusting entry. All right. So we've now earned some of that money. So we no longer have a full liability of $6,000 because we've earned part of it. So what we're going to do is we're going to go ahead and we're going to debit unearned revenue by $2,000. So that is decreasing our liability. A credit increases the liability. A debit decreases it. So we are debiting it by $2,000. Okay. So that reduces our liability. And on the other portion, we increase our revenue because now we've actually earned it. So we go ahead and we credit it. And remember, DEALOR, liability, you increase with a credit, you decrease it with a debit. That's why we decreased or debited our unearned revenue. That was LOR, revenue. Revenue we increase with a credit. So we increased it by $2,000. Okay. And if you think of the accounting equation, it still balances, right? Because the only two things that we changed is the liability. We decreased it by $2,000. We increased owner's equity by $2,000. Hey, assets equals liabilities plus owner's equity. Owner's equity and liabilities, they still balanced out on us. So we're still good. Okay. Two more categories in this that we got to take a look at. Okay, so let's look at our final two categories on this when we're looking at those adjusting entries. And it's going to be accrued, right? So we're looking at accrued revenue and we're looking at accrued expenses. So when we're dealing with accrued revenue, okay, so on that one, that's where we've gone ahead. We've done the work, but they haven't paid us. So a lot of times I'm dealing with taxes and I go ahead, I work with their taxes and then they pay me after it, right? Well, you know what? I have accrued revenue in those situations. So here we see completed $7,000 of services and the customer will be billed next month. So we haven't billed them yet. Okay. Maybe we're too busy. We haven't gotten to the billing process. We're just trying to make it through tax season, right? And super busy during those months. So we haven't yet billed them. Well, in that situation, we have accrued revenue. And because we haven't billed them or done anything like that, there has been no entry yet. We haven't entered anything. But we still need to go ahead and account for the revenue that was earned because we're using the accrual method. So we've got to account for that accrued revenue. So what are we going to do? We're going to debit our accounts receivable because they're going to owe us that money. So we've got $7,000. And then what happens is we credit service revenue. Well, we've already earned it. So we go ahead and we credit it because we're recognizing it, that $7,000. So we debited an asset. A debit increases it, and we went ahead and we credited revenue, DEALOR, our revenue, that increases it. So our accounting equation works. Assets increased by $7,000. Our owner's equity increased by $7,000. Hot damn, we got it. Okay, let's look at another one. Interest earned. We earned $500 of interest by year end that will be collected next year. Okay, so we have our interest. We collect it next year. They haven't paid it yet. Okay, that happens. Well, they haven't paid it, but we earned it. So no journal entry yet. Now, what's going to happen is we're going to go ahead and we're going to debit our interest receivables. That's an asset, right? We debit our asset by $500. That increased it. And now what we have is revenue. We've already earned it. So we credit our revenue. Okay, so this is going to be interest revenue, but we credit it. Now look at that. Accrued revenue. Notice that each time we were crediting a revenue account, service revenue or interest revenue. So see how that worked? We were going ahead and we were dealing with our receivables for our debit, and then we were crediting our revenue accounts. Okay, let's look at the final one here. I'm going to lift this up just a little bit higher so we can see all the examples. And what we're focused on is our accrued expenses. Okay, our accrued expenses. So we went ahead and we incurred all these expenses, but we haven't paid them yet. Okay, so look at the first one, employee salaries. Employees earn $3,000 that will be paid next month. Okay, so we might have been paying them every 2 weeks, but there's that period of time to where they weren't paid, but they still worked in that current month. So we need to go ahead and match our expenses to that month. So let's go see how we do it. We don't have any adjusting entry or any original entries yet. So we need to go ahead and create some new entries. We're going to go ahead and we're going to debit. So it's going to be a debit, and we're going to debit our salaries expense. So we're debiting an expense, which means we increased our expenses. Okay. And then what happens is we're going to go ahead and we're crediting our salaries payable by $3,000. So we incurred an expense and we went ahead and we incurred a payable. Notice with the payable portion of it, right? That's a liability. When you see a payable on there, there's a liability. And look at all three of these examples we're going to be using. We are always crediting a liability in those situations, right? So we have debited expenses in each of those situations, and we're crediting a liability in each of those situations. All right, let's look at the second one, utilities. This is a common one. We have our internet, we have our electricity, maybe you have, I don't know, gas, maybe you have all kinds of things, right? So you're going to have all those different types of situations of utilities that you're going to have to pay, garbage and all that stuff, right? Okay, so utility bill of $900 has been incurred but not yet received. Okay, so we haven't done anything with it yet. We still have it. We haven't been billed. We haven't done any entries with it. So we're going to go ahead and we're going to debit our utilities expense. And now what we're going to do is going to be they're crediting our utilities payable. So very similar to the first accrued expense. And the third one's going to be the same. We have interest, so we have to pay $600 of interest. $600 of interest has accrued on a notes payable. So we borrowed money, we owe $600 of interest. We're like, okay, we've got to pay that. It's accrued. We haven't done any journal entries yet. It accrued at the end of the month. Well, let's go ahead and make an adjusting entry. So what are we going to do? We're going to debit our interest expense by $600, okay? So we're going to increase our interest expense by that much, and then we're going to go ahead and we're going to credit our interest payable by $600. So that's the process that we're dealing with both of those. So we've now increased our expenses. We've increased our liabilities as well. Okay, so let's go ahead and let's continue with this process now that we've looked at these different adjusting entries. Okay, when we first started looking at these adjusting entries, I told you, you know what? There's 4 general categories, but there's actually a 5th one as well that I wanted to separate out. And that 5th one was depreciation. So let's talk about this depreciation. So when we're looking at depreciation, what happens is when we purchase an asset, a long-term asset, something that we're going to be using for over a year, what we have to do is we have to figure out how long do we think we're going to actually be using this asset? What do you think its useful life is going to be for us? So when then we figure it out, maybe we say it's going to be 5 years. So 5 times 12, we have 60 months worth of use. So what we do now is we have to go ahead and we have to allocate the expense over each of those over each of those months, right? So that way we're matching our expenses with the revenue that it's producing. So we're going to go ahead and do it by month. So we have this period cost we have to go over by month. Now what we deal with is depreciation. So what we're using for that is depreciation. So we see depreciation as a prepaid expense that uses accumulated depreciation, which is a contra asset, instead of reducing the asset directly. So we have a contra asset, which is going to go ahead and it reduces the asset, but not specifically reducing that asset. What it does is we have a new account, that contra asset, that's going to be called accumulated depreciation. Okay, and that's going to match all of our depreciation with it. So let's go ahead and let's take a look at this. So the first one, we have office equipment. We purchased office equipment for $120,000 of cash, and then the monthly depreciation is going to be $2,000. So we came up with our useful life, and after we divided it by our useful life, we got the monthly value of $2,000 every month. All right, so when we initially did this, we purchased this asset. What we did is we said, okay, we've got equipment. We have $120,000 worth of equipment. That's worth something. That's an asset, right? Remember, assets and liabilities, right? Those are going on to our balance sheet. All right, well, we're going on the balance sheet. We've got this asset of $120,000. Well, what else are we going to do when we do our entry? Well, it says that we went ahead and we purchased it. I'm assuming, it says $120,000 cash. So what happened is, we purchased it with our cash. So we increased one asset. We debited the asset for equipment by $120,000. We credited cash by $120,000. So our assets didn't really change. Each account did. The value of each account changed. Cash decreased by $120 and equipment increased by $120. Fine, but our accounting equation is still good. Now we've used a month worth of depreciation. So what we have to do is we debit the depreciation expense of $2,000. Okay, we debited of $2,000. And now what we're doing is we're crediting our accumulated depreciation by $2,000. So that's the process that we look at. Okay, and look at all of these things, all the examples that I have up here. Notice we are always debiting our depreciation expense, right? That monthly value. And then what we're doing is we are crediting our accumulated depreciation. So when you see a situation where they've used an asset and you're able to go ahead and figure out, okay, what is the monthly amount or whatever period we're using, now you know what your adjusting entries are going to be. You're going to debit depreciation expense and you're going to go ahead and credit your accumulated depreciation. And remember, we call accumulated depreciation a contra account. So unlike those other four categories where we're reducing like accounts receivable directly, here what we're dealing with is that other account is called accumulated depreciation. Again, that is our contra account. So we've now gone through those 5 different categories where we will be looking at having adjusting entries, but it's important to note that adjusting entries aren't always made. So I wanted to go ahead and I created this table so we can see some situations where there isn't an adjusting entry that's going to happen. So let's look at the first transaction. We paid this month's rent on the first day of the month. Okay, well, we paid it this month and we used it this month. So the rent expense was recorded when it was incurred. Okay, it was in the same month. We've already recorded everything that was happening in that month. There's nothing that we need to adjust. It wasn't a prepaid expense. Okay, the second one, pay 12 months of rent in advance. Prepaid expense. Yes, we do need to go ahead and we need to go ahead and take 1/12 of that because we've used it for this month, 1/12 of it. Okay, so we have a prepaid asset that has been consumed. All right. Now let's look at the next one. Received cash after completing our consulting services. Hey, no, we received our cash on that. So revenue was recorded when we earned the cash, was received simultaneously. We don't have to. If we receive cash, so we're paid when we complete our services, we already have it recorded in the proper year. It's not like we went ahead and we had revenue this year and then we're going to receive payment next year or pay or vice versa. Okay. The next one is going to be completed consulting services, but will bill the customer next month. See, we have to bill them. We need to go ahead and adjust it. So we have an adjusting entry because revenue's been earned, but not yet recorded. We need to make sure we're recording it in the period in which it was earned. We need to adjust it. And then finally, employee worked during the last week of the month, but will be paid next month. Yeah, we need to go ahead because Those were expenses that were incurred in the year that we used to help create revenue. So we need to go ahead and match it. So the salary expense has been incurred, but not yet recorded. So we need to go ahead and match that. But let me give you a couple situations where you're not going to make adjusting entries, and professors love to ask questions on this. So let's take a look at that. Hey, if this video has been helpful so far, remember to go ahead and subscribe to this channel. I have the entire playlist, the one that you're watching right now, dealing with the Intro to Financial Accounting. In addition, I have entire playlists on Tax 1, Tax 2, Business Law 1, and I'm working on Business Law 2 as well. And then I also have all kinds of things with relating to playlists, such as the entire 1040 and life events, going to college. So what are some of the tax consequences associated with that? Your first job, having a child, getting married, all kinds of things that are going to impact you throughout your entire life. So go ahead, subscribe to this channel now so you always have access to that. Okay, let's go ahead and look at some situations. And these are extremely important. These are things that professors love to test on. And it's not that much to learn here. But let's look at this. So we have our situations to where we do not make adjusting entries. And watch this. Cash is exchanged at the same time revenue is earned. So if cash is occurring at the same time, then we don't have to worry about a timing difference because we have cash as it's earned. So you don't have to worry about that. So what's happening is our journal entry is we debited cash for $5,000. We credited service revenue for $5,000. So it was recorded when earned. There is no reason to go ahead and make an adjusting entry. Look at the second one. Cash is exchanged at the same time an expense is occurred. Okay, so if you're receiving cash when the income is earned, or you're going ahead and you're paying cash in the same period that you have the expense, there's nothing to adjust. We would have had debiting rent expense, okay? And then we would have gone ahead and we would have credited to decrease our cash, and that is it, okay? The other situation, so if you have a cash transaction, you're not dealing with these adjusting entries. Cash transactions, you don't have to worry about this. The other one is the transaction does not include a revenue or expenses. You're always dealing with revenues and expenses when you're dealing with these different types of transactions. If it's not a revenue or expense, that's what we're trying to do is we're trying to match those, right? If you're not dealing with at least a revenue or an expense, then guess what? No adjusting entries. Okay, so we don't have to worry about it. So if it's only balance sheet accounts are affected. Okay, so only balance sheet accounts are affected. So look at this one. We debit equipment, $25,000. We credit cash, $25,000. All right. Well, I'm not seeing anything that's saying that there's revenue. I'm not seeing anything that's saying there's an expense. All I'm seeing is we are going ahead and we're increasing our equipment. We're decreasing our cash. And that is it. Those are only balance sheet. No adjusting entries are made. All right. Well, let's continue on. All right, we're at the fun part. We get to apply everything we just talked about. And what I decided to do is to use the numbers that we did in our second video in order to go through and complete the entire accounting cycle process. Now, here's the thing with it. If you haven't seen the second video, or if you don't remember the content or the numbers from the second video, what we're going to do is we're going to start with this unadjusted trial balance, which we took from the second video. So that way you have the numbers. So you don't have to be familiar with all the transactions. You're going to see where we go from the unadjusted trial balance, which is what we did in the first video. And then from the unadjusted trial balance, you're going to see how we go through and make our adjusting entries all the way through the financial statements and the closing entries. So you're going to see everything else at the end of the period now. Now, here is that unadjusted trial balance that we did in video number 2. And what we have is our different debits and our different credits. So we have cash, supplies, prepaid expenses. So you can see $57,000 for cash, $4,000 for supplies, prepaid insurance is $6,000. Now what's going to happen is what we're going to see is some additional transactions that occurred. So we had our supplies, which is an asset, right? Because it's a value. Well, now we're going to have a situation where we look at the end of the period and we're like, oh, we used some of that supplies. So we need to make that adjusting entry so it reflects what our actual value in supplies is going to be, because we aren't going to have the full $4,000 because we've used some of it. Same thing when you see things like the prepaid insurance. We used a month of that prepaid insurance. We paid it in advance. Now we've used a month's worth of it. So we've got to go ahead and we've got to reduce that. So our asset over there, our prepaid insurance, is reflecting the actual amount that we have. And we're going to go through all of these. So, or at least all of them that we're going to be impacted with these additional transactions. So let me pull up some transactions for you so that way you can see these additional transactions and we can go through and make the adjusting entries. So let's go ahead and take a look at that. So these are now our transactions. You see a second table that I just added up here. These are the transactions that we need to now go ahead and account for. These will be requiring our adjusting entries. So if we look at these additional transactions, we say, okay, the first one, a physical count shows 1,500 of supplies remaining. All right, well, if our current unadjusted trial balance is showing $4,000. We know there's not actual $4,000 worth of supplies anymore. There's only $1,500. So we need to go ahead and have an adjusting entry that shows that $2,500 of supplies have been used. Same thing. We have for the second one, the $6,000 insurance policy was for 12 months. Well, we've now used 1/12 of that. So what we're going to do if we had $6,000, well, if it's $6,000 over 12 months, that means each month is $500. So now instead of having $6,000, we only have $5,500. So we need to go ahead and make an adjusting entry that shows that we've used $500 of our prepaid insurance. The third one, employees have received $1,000 of salaries that will be paid in February. Well, they earned it in January, so we need to go ahead and show it in January, right? We need to go show it in January. So we need to have an adjusting entry that shows that we're going to have salaries used in January. So we need to make an adjusting entry for that. BW Consulting completed 2,000 of services for the first half, but we have not billed them yet. Okay, so we earned some money, so we need to go ahead and show that the revenue was earned in the current year, and then we're going to receive it in the future. So we'll have a receivables, but we need to go ahead because we haven't billed it, so it's not showing up on our unadjusted trial balance right now. We need to go ahead and make sure it appears on there. And then finally, what we have was our monthly depreciation on equipment of $500. Okay, so we've used some value on that equipment. We've used it as an expense, right? So we need to show that $500 expense on, so that way we don't look at it and overvalue what we actually have. All right, well, let's go ahead and let's start the process of doing these adjusting entries now. Okay, so let's go ahead and do those actual adjusting entries that we've been working on throughout this whole video. So the first one that we're dealing with is that additional transaction. We said a physical count showed that there's 1,500 of our supplies remaining. Well, when we're looking at our unadjusted trial balance, we said that there were $4,000 worth of supplies, but now there's only 1,500 left. So we've used $2,500 worth of supplies. So how do we do it? Well, here's our adjusting entry. We're going to go ahead and we're going to start out by debiting our supplies expense of $2,500. Remember, supplies expense is an expense. So when we're looking at our dealer, DE, right, we have our expense. We increase an expense with a debit. So we've increased our expenses by $2,500, and we went ahead and we go ahead and credit our supplies by $2,500. And the credit on supplies reduces it. So now at the end of this period, we're going to only have $1,500 worth of supplies, which is what we should have. That's what our unadjusted trial balance should be showing, which we'll go ahead and we'll go through the financial statements and everything else with it. But we're going to see it's now $1,500. Okay, the second one that we have here is going to be that $6,000 of a homeowner's policy that covered 12 months, but we've used 1 month of it. All right. Well, our insurance expense over here was $6,000 is what we initially had in that account for our prepaid insurance, but we've used 1/12 of it, so we've used $500 of it. So we need to go ahead and reduce it by $500. How do we reduce it? We have an adjusting entry because we've used it through that month and it doesn't show up currently on our transaction. So we make this adjusting entry. So we start out again with our expense. So we now have that expense. And it's going to be an insurance expense because we used insurance to help us create revenue through the year. So we have our, or through the month. So we have our insurance expense, and that's going to be $500. And then we reduce our prepaid insurance by going ahead and crediting our prepaid insurance account by $500. And that's going to reduce the amount that we have in there. And it's going to adequately reflect that now our prepaid insurance is only worth $5,500, no longer $6,000 because we've used $500 worth of it already. Okay, Our third one, let me pull this up so we can go ahead and see what we're dealing with. Our third one is going to be employees have earned $1,000 of salaries that will be paid in February. All right, we need to go ahead and match those salaries in the month in which it was used, which was January. So as we're looking at this, what we do is we say, okay, we had accrued salaries. We didn't have an entry for it yet, right? We didn't do anything because we haven't paid it or done anything with it, but we have to create that entry now. So it's an accrued. So what do? We have a salaries expense. It's one of our expenses. It's going to reduce our net income, right? So we have an expense in there, but we still have to pay it. So we aren't using cash. We're not going to be decreasing an asset or anything like that. But what happens is we're going to be going ahead and we're going to have a salaries payable. Okay, it's a salaries payable. So at that point, we're going to go ahead and we're going to credit our liability. Okay, and remember, DEA, LOR. So what's happening on that? DE, so our expense, our salaries expense increased by 1,000, so our expenses went up. And then look what else happens over here. We have our payable, so now we owe more money on that, right? So that's going to be a liability. We increase our liability also with a credit, right? So we're going to go ahead and increase it by using our credit. So we've increased our expenses and we've increased our liabilities on this one. Okay, so let's go through and talk about the fourth one. The fourth one, we have the consulting gets $2,000 of services that has not yet been billed. Well, we haven't billed it, so it's not going to be on our financial statements. So accounts, so what we said is a service for the applicable services performed, but not yet billed. All right, so what are we going to actually do on that one? Well, here's what's happening. We have our accounts receivable of $2,000 and our revenue of $2,000. We've earned the revenue, so we want to go ahead and recognize it in the current year because it's already been earned. And what we do is we say, well, we have an asset because we are entitled to receive it. Okay, so we have accounts receivable of $2,000, which we debit, and we're going to have our service revenue of $2,000 because that revenue is coming in. And then finally, we have our fifth one. It says monthly depreciation on equipment is $500. All right, well, we're dealing with monthly depreciation. So remember, this is our Contra account when we're dealing with depreciation. So we have our depreciation expense of $5,000, and then we have, which is debited, and then we have our accumulated depreciation of $5,000. So we're not directly reducing the value of the asset, but we have this accumulated depreciation account that goes ahead. It's allowing us to recognize the expense and also creating a reduction indirectly in what our assets are on that. Okay, so this is what we're looking at in terms of the adjusting entries. So you can see what the adjusting entries should look like. Hopefully you're able to get these based on the beginning part of this video. But now what we want to do is we want to take these adjusting entries and we want to start looking at what do we do with these adjusting entries. So we need to go ahead, and now what we need to do is we need to adjust our trial balance. But before we can do that, let's go ahead and look to see what our new adjusted balances are. So what do I mean by that? Well, I mean, we had our unadjusted trial balance, right? We had the amounts from the unadjusted trial balance. And now we're accounting for those adjusting entries that we just did, right? And we could be doing this through those T accounts that we previously talked about. But here's what it's going to come out to. Okay, so cash, we didn't impact cash, right? Adjusting entries aren't impacting cash. So we had $57,000 unadjusted. We still have $57,000, and it was a debit account. All right, then we had accounts receivable. Well, we had to create the accounts receivable account because we earned revenue at the end of the year that we had not yet billed. So we went ahead and we said, oh, well, with our adjusting entries, we had to create accounts receivable of $2,000. We previously didn't have an accounts receivable account, so we now have accounts receivable $2,000 with a debit balance. Supplies, we had $4,000. Remember, we went ahead and we used $2,500 of those supplies. So now we have $1,500 of those supplies. Prepaid insurance, $6,000 is what we had, but we used 1 month, which was $500. So now we have an adjusted balance of $5,500. And you can see the rest of them. I'm not going to read through all of these for you, but if you need, you can stop the video and just kind of check this out. But those adjustments came from what we just went through. So if you need to rewind the video a little bit, you can see where those adjusted amounts actually came from. Okay, so that's what we are focusing on. Now, what we're going to do is we're going to take these values that are over here, the 57,000 and the 2,000 and the 1,500 and the 5,500, and we're going to go and we're going to revisit that unadjusted trial balance, but now we're going to incorporate these adjustments so we'll have our adjusted trial balance. So let's go ahead and complete our adjusted trial balance. All right, so now you can see in the title here what we have is our adjusted trial balance. So the other one was the unadjusted trial balance. It looks very similar to this one, but what we're dealing with now is the adjusted trial balance. So all I'm doing is I'm taking those balances from what would have been our T accounts, or on the last image I showed you, the last table, it showed you our new adjusted balances. I'm just taking those and now I'm putting them in our adjusted trial balance. So what we'd have had is cash was at $57,000. We did the accounts receivable, which was $2,000. Supplies, the new value, it wasn't $4,000. We used $2,500. So what we had was $1,500 remaining. Prepaid insurance, we used $500 of the $6,000. So now we have $5,500. Our equipment is $15,000. So you can see that we're just taking those values from what we just went through and we're just putting them on here. And what we're trying to do is make sure that our debits and our credits are going to actually match, right? And they do here. So that's what we're dealing with here. And we have this information now, so we're able to go ahead and start to do our different financial statements. So we can go ahead and start working on income statement, statement of stockholders' equity, and we can move on from here. So I'm not going to go through and include every one of these values. We've talked about the trial balance before, so you're familiar with the trial balance. You know where those values came from, so you can go ahead and look at the last table and make sure that those values have appropriately carried over. So let's go ahead. Let's take it to the next step. Let's look at our financial statement. Let's look at our income statement. And remember, our income statement is going to go ahead and measure our performance during the year. So over a period of time. And what we're trying to do is we're trying to determine, do we have net income or a net loss? What happened with it, and seeing what our revenue was and what our expenses were. So let's go ahead and take a look at that. Okay, so we're finally looking at our income statement. Now, with the income statement, what we're trying to do again is we're measuring our profitability during the year. We're trying to figure out what our net income or our net loss was if our expenses are greater than our revenue. So we start out, this is just for the month of January. Okay, so it's a period of time. It's just for the month of January. And what we say is our service revenue was $15,000. Well, where did I get that $15,000? Okay, just go back to your unadjusted trial balance that we just, or your adjusted trial balance that we just looked at, and you're going to see the $15,000 there. So that's where we took it. We just took this straight from our trial balance. We have $15,000. And then what we have are those expenses that we also had from our trial balance, right? Our expenses of salaries expense, $4,000. Our supplies expense, $2,500. Our insurance expense, $500. And our depreciation expense, $500. So we had a total of $7,500 of expenses. Well, if we had $15,000 of service revenue and we had $7,500 of total expenses, if we subtract those, we have $7,500. Our revenue was greater than our expenses, so we have net income of $7,500. Okay, so that's what we're looking at so far. Now, what we still need to do is we need to take a look at the statement of stockholders' equity. But before we do, I want to go back and I want to look at the adjusted trial balance just to show you something real fast. Okay, I just wanted to go ahead and pull this up so that way you can see where those amounts came from. Here was our $15,000 of revenue. It just came over here from our adjusted trial balance of $15,000, and then we saw the $4,000 and $25, the $500, $4,000, $25, $5, and $5. So that's where we got the $7,500. So I just wanted to make sure that you saw that this was coming from the trial balance. Okay, now let's go ahead and take a look at our statement of stockholders' equity. Okay, so what we're dealing with when we have the statement of stockholders' equity is we're taking the amounts from our income statement, right? That net income is going to flow over to our statement of stockholders' equity, and it's going to appear in our retained earnings. Okay, because remember, when we have net income, there's two things we can do with it. We can either pay out with dividends, or we can go ahead and we can retain it inside the business as retained earnings, and we can reinvest it within the business. So here's our statement of stockholders' equity. And again, it's showing us just for the period of January. So it's from the beginning to the end of January. Well, our beginning balance was zero because we didn't have anything. We didn't have any type of stockholders' equity because we just started it. We're pretending as though we just started it in January. So what we did is we went ahead, we invest $50,000. So let's say that we invest $50,000. We now have common stock. So we're going to increase it with common stock. So you can see the second column is going to be common stock over here of $50,000, right? And then what we're going to do is we don't have any other types of investments like that. So it's just common stocks or $50,000 is all we've dealt with. Then what we deal with is our retained earnings. So when we're looking at our statement of stockholders' equity, we have common stock plus retained earnings equals our stockholders' equity. Now, when we're looking at retained earnings, remember, we're dealing with several different things, right? We're dealing with both our net income, and when we calculated net income, that was revenue and expenses. So revenue and expenses impacts our retained earnings. But when we're bringing this over from our income statement, we've already accounted for our income and for our revenue and for our expenses to get to our net income. All right. The other thing we have to do is we have to account for anything that we paid in dividends. If we decided to pay out dividends, we have to account for it. So if we look at our retained earnings, what's happening is you're looking at it and you're like, okay, wait. So we didn't have any balance because we just started. Fine. So then you go to the net income, right, which we took from the income statement. We said we had $7,500 because we had $15,000 of revenue, $7,500 of expenses. So our net income was at $7,500. So we put our $7,500 there. Now we're paying $2,000 in dividends to the owners, so we need to reduce our retained earnings by $2,000 because we didn't retain all $7,500. We only retained $5,500 because $2,000 was paid out. So we have $5,500 still in the business that we retained to reinvest it. So when we go ahead and add these together, we have our common stock plus our retained earnings. That means our stockholders' equity is going to be $55,500. So we have $55,500 from common stock and retained earnings. This is how we do our statement of stockholders' equity, and it tells the owners, hey, here's what our financial interest is in the business. This is what we have. Okay, now what we're going to do is we're going to take the statement of stockholders' equity and we're going to bring that over to the balance sheet because that appears in the balance sheet. Remember, the balance sheet is giving us our accounting equation. Assets equals liabilities plus stockholders' equity or owner's equity. Well, owner's equity is right here. We already have that. Okay, so we're going to go ahead and put that in our balance sheet. Let's take a look at that balance sheet. Okay, so we're looking at the balance sheet. Now, we've already done the income statement and we've already done the statement of stockholders' equity. Now, when we get to the balance sheet, what I'm going to do is I want to show you the bottom of the balance sheet first, so that way you can see where the statement of stockholders' equity came from. But here's one other thing I want to mention. Remember, the balance sheet, that's that photograph, right? That's on a specific day. That is our assets, liabilities, stockholders' equity on a specific day. It's our financial statement that's not measuring it over a period of time. So let's go ahead, take a look at the statement of stockholders' equity portion of it. So here's what we were talking about. We had our common stock of $50,000 that we just did from our statement of stockholders' equity. We said our retained earnings was $5,500. Okay, so that was after we took out our dividends, and that gave us our total stockholders' equity of $55,000. So we just took that from our statement of stockholders' equity, and here it is. It now appears on our balance sheet. So that's where we're saying things are always interrelated, because when you have something like an expense or revenue, it impacts our income statement because it impacts our net income, right? Because revenue minus expenses. And then what's going to happen is if it impacted that, it's impacting our statement of stockholders' equity because it impacted our net income. And then because it appears on our income statement and as part of the statement of stockholders' equity, then it comes over to our balance sheet. So we see that it continues to impact every different type of financial statement. Okay, let's go back to the top of this balance sheet and let's take a look at this now. So we know that our assets have to equal our liabilities plus owner's equity. So what we're dealing with now is an expanded balance sheet, right? So we have our current asset. Those are assets that are very liquid. Within 12 months, we're going to be able to convert them to cash, or we're going to be able to use them. So what we have is cash of $57,000. Again, that came from our adjusted trial balance. We have our accounts receivable of $2,000. Our supplies, after we went ahead and accounted for the use of it. Remember, we made those adjustments. We had the adjusting entry, and then we had our adjusted trial balance. Well, we had $1,500 remaining, so that's where this came from. And our prepaid insurance, after we used 500 of the 600, 500 of the 6,000, we had $5,500 remaining. So we took this from our adjusted trial balance. And that gave us our total current assets of $66,000. Then what we do is we account for our long-term assets, which is going to include things like equipment, right, which was $15,000. But we had to deal with our accumulated depreciation, and that's where we end up with, instead of $15,500, we would subtract that out, and it'd be $14,500 for our long-term assets. So if we go ahead and we take $66,000 and we add in that $14,500, then we're going to end up with our $80,500. Okay, we have $80,500 for total assets. So that accounted for all of our current and long-term assets. Remember, a long-term asset is going to be an asset like machinery, equipment, building, land, property, all those things. That's going to be over a year in value. We're going to be using it over a year. It has a life of over a year. Okay, then we come over here and we come back to the top. So we know that between our stockholders' equity, which we came out to $55,500, right? We know between stockholders' equity that the liabilities have to equal $55,500 plus the liabilities has to equal our $80,500. Let's see if it does. It has to balance. Otherwise, we messed up somewhere. Okay, so we have our current liabilities. Liabilities will be paid within a year. So we had our accounts payable, $4,000. Our salaries payable, in this situation, we incurred it toward the end of the year. We have $1,000. We hadn't recorded it. Our total current liabilities are $5,000. All right, so we have $5,000. Now what we're looking at are the long-term liabilities. So we took out a bank loan, right? That bank loan, well, we have $20,000 on the bank loan. So between our total current liabilities and that long-term liability, something that we paid over a year. All right, so between our $5,000 of our total current liabilities and our $20,000 of our long-term liabilities, we have total liabilities of $25,000. All right, so we've now gone through and we've looked at our assets, our liabilities, and our owner's equity. Notice we don't have any revenue or expenses directly on this. The only way that they appear is through our stockholders' equity. Okay. Now let's look to see what happens. So we take that $25,000 of total liabilities plus our $55,500. Well, that equals $80,500. Hey, we balance. We balance. Our total assets equals our total liabilities and stockholders' equity. And that's what we expect to see. That's the balance sheet. So that's what we're dealing with our balance sheet. All right. Now, there is a statement of cash flows, but we have an entire chapter that deals with the statement of cash flows. So this video is already long enough. I'm not going to deal with the statement of cash flows in this video. We'll do that in another video. You'll have an entire video that deals with statement of cash flows. Okay, but there's still some things that we have to do. You see, we still need to go through and we need to do some closing entries because we have what are called temporary and permanent accounts. And what we need to do is we need to close out our temporary accounts into our permanent accounts so we start out at zero. You know, what am I talking about? That doesn't make any sense. Well, you're right. Right now it doesn't, but it will make sense here in just a second. Let me go ahead and pull up another table for you. Okay, let's go ahead and take a look at our closing entries. Now, our closing entries, what the purpose is, what we're doing with this closing entry is we need to take the amounts that we have in our revenues, our expenses, and our dividends. Notice they all come from the income statement. Our revenue expenses, and dividends. And we need to bring those down to zero. We need $0 remaining in it because next period, we need to measure how profitable we were the next time. We need to figure out our net income, and then we need to figure out, okay, do we pay dividends? So we can't have a balance over. Otherwise, we're not going to know how profitable we were in the second period. So what we do is we close those out. We need to give them a $0 balance. So when we're looking at revenues and we're looking at expenses and we're looking at dividends, we call those temporary accounts. They're temporary because at the end of every period, we're going to make sure they're zero. And then what we do is when we close them out or we're making a journal entry to show that they're going to be zero, we're putting that into retained earnings. Retained earnings, we don't zero out. That's always there. It's cumulative. So we call that a permanent account. So we're going to close out our revenues, expenses, and dividends into retained earnings. And the next period, we're going to have zero to start out for revenue, zero for expenses, zero for dividends. All of that will be sitting in our retained earnings account. How do we do this? Well, we have our journal entries. These are our closing entries. So let's look at the first one. We have service revenue. We are going to go ahead and we're going to debit service revenue of $15,000. Why do we debit it by $15,000? Well, think about it. DEALOR, right? LOR. So when we're looking at it, well, if we have revenue, that is a normal credit account. So if it's a credit account, if we debit a credit account, then it decreases it, right? A credit in a credit account increases it. So to increase our revenue, we credit it. To decrease it, we debit it. Well, that's what we're doing here. We're debiting it by $15,000. So we had a $15,000 balance in our revenue, service revenue. Now it'll be zero because we credited it by $15,000. That's how we close it out to zero. That's all we're doing. And then we're closing it out by crediting our retained earnings. All right. Now let's go to the next one. We have our expenses. So we've done revenue, expenses. Same thing here, except what we're dealing with retained earnings is we're decreasing retained earnings, okay? Because we're going to decrease it with a debit because it's an expense, right? So we have less to hand out or to keep. So we debit our retained earnings by each expense. And then what's going to happen is we're going to go ahead and we're going to credit all of these different types of expenses, right? So we're going to credit our specific expenses. Why are we crediting those? Remember, DEA, right? So when we're looking at it, we had our different accounts, but the E in dealer was our expenses. So that's a debit account. DEA were our debit accounts. So if we increase them with a debit, the way we decrease them is with a credit. So that's why we're going to go ahead and credit all of these different accounts. Okay. Same thing when we're dealing with dividends. D, right? DEA. So we're looking at it and we're saying we debit dividends, expenses, and assets. Well, we're debiting it to increase those. So if we go ahead and we credit dividends, we're going to go ahead and we're going to decrease those. Okay. And of course, because we're paying dividends, what happens is that reduces. So we debit our retained earnings in that situation. So what basically happened is at the end of this period, we're now going to have $0 in our service revenue account. So our revenues will be zero. All of our expenses will be zero and our dividends will be zero. And that balance was now carried over and put into our retained earnings, which was a permanent account. The revenues were going ahead and increasing our retained earnings. The expenses and dividends reduced our retained earnings because we don't have that money in there any longer. So that's the way that we handled that. We've got one last thing to look at. We're almost there, y'all. Just about there. Hey, we won't spend much time on this one. I just want to make sure that you see what we deal with is a post-closing trial balance. So we had our unadjusted trial balance, we did our adjusted trial balance, and then after we've gone ahead and we've done all those closing entries so we don't have anything left in revenues or expenses or dividends, now what we're going to do is we're going to have our post-closing trial balance. And you can see here we have our cash, receivables, supplies, prepaid insurance, equipment. So we have all of those put up there. We have our credits over here, but look at the things that are not included in there. So I'm not seeing anything that says we have a revenue. I don't see anything that says we have any types of expenses. I don't see anything that says we have dividends, because those are all now zero. We've zeroed all of those out, but do notice that we do have, toward the very bottom, right above the totals, our retained earnings. So our retained earnings survived because that was a permanent account. Everything you're looking at on this post-closing trial balance, those are our permanent accounts. So we weren't having to close out the values on those. Hey, thank you so much for hanging in there. I know this is a long video. I know financial accounting can be difficult, but I hope these videos are helping you as you continue to make it through your financial accounting course. If you have questions, always feel free to put them in the comments. And good luck as you continue working through your financial accounting. I will do our next video in the cycle, and I'll have that posted here in a couple days for you.